Good afternoon, everybody. It's November 6th. You're tuning into the Stock Market Brief Show. We're going to dive into what took place in the markets, give you some updates on market conditions and expected moves. Today's video, it's going to be quick and to the point. We're going to start off here looking at the performance, right? It felt like a big day today, right? Because the S&P 500 moved a whopping 1% into the downside. The NASDAQ 100 finished almost down 2%. The NASDAQ Composite, the same situation. We did have two sectors in the green. Remember, there's 11 sectors that make up the S&P 500, and we had energy and healthcare lead the way. Towards the bottom, we had tech and consumer discretionary, the wants and the cool stuff, right? Those down 2%, and that's really going to put weight on the market. You can see that here on the heat map. The reason for it is because those are the biggest squares. It's a cap-weighted index, so that NVIDIA, 3.65%, getting outside of its weekly expected move. Tesla finished down 3.5%. Meta down 2.67%, continuing to get crushed. And then Microsoft also came under its weekly implied move and closed under there too as well. The question on everybody's mind right now, is this going to lead to something bigger, or is this kind of a shakeout, fake out to the downside before potentially heading higher for the whole Santa Claus rally that's to come in the near future? If we take a look at the weekly implied moves for this quarter, so this week, that week, this week, that week, this week, that week, those are the weekly expected moves for this entire quarter. We have tagged it each and every single week, and we've had one breach, and the breach happened to be over here on that big down day. Today, we closed outside of the weekly implied move, and we still have one more trading day left. So are we going to get another breach, or is it going to finish back within it? The probabilities suggest that it's going to come back within the weekly implied move and hang out in and around there. But you never know. Something can happen where if we break out further, we have a more significant move. Now, if I show you what the daily expected moves look like, we came into it, we saw a little bit of a bounce, we broke through it, came to the weekly implied move, came back up, and then came right back down into the close. Going into tomorrow's trading session, our daily implied move to the downside would be 664 to 663, and to the upside would be 675 to 676. If we start moving up like so, just keep in mind, you are still below the declining 5-day moving average and the all-time high VWAP and the week-to-date VWAP. Okay, so the bears are in control right now. So one of two things you got to think about. One, you got to be patient and wait for the bulls to prove itself. Two, you tried to prove to the market that you're correct before that it proves itself correct. And if you do choose that route, make sure that you're managing risk, expectations, your sizing, and so forth. Because if you're wrong, you want to get out quicker, right? Because this thing can continue to break down. But if we were to pop up, also be aware that you're still fighting a downwards trend. So move up into here, people are going to get pumped up, excited, everything's good, but you still have a lot to overcome. So if we were to come up here, maybe next week we start doodling around, these things start to curl, flatten out, get back above the white line, which is the all-time high VWAP, and then it opens the door for some nicer moves to the upside, but we're still fighting that current trend. We did slip into negative gamma territory today, as you can see over here, that blue bar. These are very important to pay attention to, because it has the potential to lead to something bigger. And what I mean is these gray shaded boxes right here represent the times that we were in negative gamma. And you could see here that when we go into negative gamma, or when we slip under the gamma flip line, there's a high likelihood of volatility increase, because dealers, they're selling into selling, they're buying into buying, and volatility typically increases. You can see though, the last few times that we've gotten in, it lasted maybe 1-2 days. So all throughout here, you see these shaded boxes, like one big pop, and then we recovered quickly. This time over here was in February to mid-April, right? When the market was going off all the tariff tantrums, it gave us a big heads up notice right over here. And that's why we were so prepared for this year, is because this. So now, once again, you just got to be prepared for the potential for something like that to happen. I will note that the VVIX, the volatility of volatility, is not at an extreme level by any means right now, which is more of a positive sign for now. But typically above that 110, 111 area, you got to be a little bit more cautious. If we look at back month, first front month volatility, we did get to that 20% higher, and it's backed off since then. When we get below 1.0, that's where you start to find shorter term bottoms, consolidations, pullbacks, ups, and so forth. But right now, it's kind of in no man's land as it stands. If we look at the VIX futures curve, it is not in backwardation, right? This isn't contango. So this is, what you want. You want the market to say, hey, there's going to be risk in the future, right? That's what it's basically saying, right? I use the analogy as like you're preparing for a marathon. You're practicing, and into the future, you know that you're going to deal with like running 26 miles. It's going to be hard. It's going to be, rough. And when you get there, when you get to the, starting line and the gun goes off, that's when all of a sudden the line will look like this. That means you know that in the future, it's going to be easier because you're going to cool down, you get a rest, and it's going to be over. So right now, right, the marathon's out here, so we don't need to necessarily worry. We're just right over here. And VIX, it's not, I wouldn't say it's really massively elevated. We're at 20%, right? So it's been higher than what it usually is, or 19.85%. So we're higher than what it usually is, which means that we're getting more intraday volatility. And we discussed that on yesterday's video, okay? So nothing really too crazy to worry about there. As far as the S&P 500 SPX goes, we have 670, 6771 above us, 6669 below us for the daily implied moves. And you see that gamma flip line is roughly right about that weekly implied move. So we're right in really that gamma neutral zone. You want to get back above that because it's be significantly bullish. If we start breaking down, remember, we now have the potential for CTAs to become sellers, right? Especially if we hold down here, and then also vol control funds to continue selling. So these are things that need to be recovered quite quickly. If we take a look at the direction of the 5-day moving average, it's still all red. Remember, we talked about it when it was turning yellow and red early on. We said this is where you got to be patient and let the market prove itself. It hasn't done so yet, but that's why we're being optimistic. We got to be patient. If we take a look at the 10-year yield, it did back off. I had a feeling that this was going to be the case, and the reason why I kind of thought that this was going to be the case, at least for the near future, it was because of oil, right? Oil was down now 2 days in a row, and the 10-year yield went up pretty significantly. And there was a lot of, the reason why I wanted to see it digest is because the macro news, sometimes you get these, first, moves, and they end up getting reverted very, very frequently. So we got some macro data and the 10-year yield flew up, and now it basically fully reversed itself, and oil is still going down. Okay, so oil can be a good leading indicator of where bonds could go. So when I saw that yesterday, I did take I added to a bond position, and then I subtracted some today because we saw a massive move up back, 0.9. So we're still, seeing that pullback. Now we're seeing a bounce. Is it going to hold and continue up higher? Strong possibility, right? Because why? Well, we've been seeing these higher lows form and these higher highs. So this is just one of those pullbacks as it stands. If we take a look at the bullish percent index for the Nasdaq Composite, it is in that oversold condition. Crazy to think that, as it's, the market's just coming in a little bit. I will note that it's not by any means an oversold condition for the reading itself, right? We're at 52.5, but the RSI is in that oversold condition. BPSPX chart did move into an oversold condition too. Crazy to say that, as the market's only down like 3% from its all-time highs, but we're also getting a pretty, reading that we actually haven't seen for the bulk of this year, right? So 45%. If you go back over here, you have to go, where we had all this volatility in April, March and April is the last time we were there. So it's been a minute since we've actually had a reading this low. Now, on the bright side of things, we're in negative gamma and all this stuff, but on the bright side of things, both high yield corporate bond and investment grade LQD, they both finished up on the trading session today. And that's like more the smart money, right? So back, just the other day, actually, they took a huge, huge hit, and S&P 500 was up. And we talked about that being like a little bit of a warning shot. Like it was a little off to see that. And then the very next day in the S&P 500, it was down. It was down a whopping, 1% or whatever it was. It caught to the downside. Okay. Well, now we're putting in a higher low, and then the S&P 500 put in a lower low. Now, if you go back over to here, we call this out too, where the SPY kept on pressing higher, but yet high yield was going lower. So the smart money was saying, I'm not interested. This was going up higher. And this is, this is very important to pay attention to. I'm only using the 60-minute line chart here, and it's never perfect, but I do pay attention to these divergences. So will it mean something? And if it means something, what does that mean? If it actually plays out to the upside and the high yield goes higher, that means S&P 500 could potentially bounce from here, or in the very near future, okay? Now, if all of a sudden HYG gets cracked and these lows get taken out, well, then guess what? Then this divergence no longer matters. The last chart I want to finish off with is not my chart. It's from Nicholas Savino from X. I thought it was kind of an interesting chart because he looks at cycles, and I like to look at seasonality on occasion too, but you can see over here, this is the updated cycle chart for the month of November. And you can see these little yellow areas down here, these little highlights. This is just when there's no trading session. So it's going to go from, one more trading session, it's going to skip over here. And you can see we started up. Now you can see that we're pulling back into kind of that seasonal period, cycle period where we typically get a pullback. And now we're moving into an area where we actually see the rally move up higher. And then right at around the 19th to 21st, there's also some more sell side. And I figured I'd show you last month's that he posted too as well. This is for October. And it worked pretty well, right? The market went up higher just like this did. And then all of a sudden coming into this, we saw that sell side. Then we started to see it rally here towards the end of the month. So we'll see if we get something similar. But if this is the case, we're kind of near that bottom before rallying and potentially seeing more sell side more into the middle of the trading month. Hope today's episode helped out, gives you some insight. I'll see you on the next.